Welcome back, everyone. My name is Wolfe. For those of you who don't know, you can check me out on all social media platforms at EveryTimeICash. You can also reach out to me directly on my website, www.everytimeicash.com/contact. If you want to reach out, you can do so there or just at me on pretty much any social media platform at EveryTimeICash. This is going to be both a video and audio version of the podcast. So if you're listening to this, you can check it out on my YouTube channel at EveryTimeICash, or if you're just watching this and want to hear the audio version, you can check that out as well. This is going to be a little bit of a rewind versus where we are today versus where we were the last time that I created a YouTube video and a podcast about the markets. So if you're watching, in front of you, you have the S&P 500 daily chart. You have the chart from last year, July, until today. And the interesting thing here is there is going to be a little bit of chaos that took place between February and late March, which of course we all know that had to do with the COVID-19 and with the markets in turmoil as CNBC ran daily. So what I want to go over in this chart is a couple of different scenarios and a couple of different ways to anticipate a market playing out here. First and foremost, it's important to notice that the market is grinding higher. So the last time that I made a video, I indicated that my bias was for a little bit more upside, and it was to see the market kind of float higher. We have been doing that, and that is something that is playing out in the market. As this is continuing, what you're going to see and what you are seeing here on your screen is a confluence of moving averages for the S&P in particular here. And what this ends up being is the more that the market will grind and the more sideways action that you'll get without any particular downside resolution. So the more that the bears can't push the market down, the more that you set up for more support in the marketplace. And the reason that is for a couple of things. Number one, when we first started selling back in February, you had funds and managers net long on pretty much the most historically long bias that had existed in the marketplace. So pretty much everybody was tilted one way in the market. And then we also had the lowest amount of put protection that we saw in the market, pretty much on record at that time as well. Both those items set up for offsides positioning in the marketplace, with everybody kind of looking for upside. So when we had the COVID-19 thing start, you saw an exasperated and accelerated move to the downside. And that was pretty much for a couple of reasons, but the primary reason was everybody was kind of leaning one way in the same direction, and it set the door open for pretty fast and pretty violent downside. Now, since that's taken place, the Fed has taken a unprecedented position to firm up the marketplace. Now, we can argue about whether or not that's something that should happen or whether or not that's something that's going to be positive in the long run. But in the short run, what we need to understand is that there is a Fed put. And so that term just basically means Fed's got the markets back. And they did this, and they're in the puts in place on the bond front, which more recently, as of last couple of weeks, the Fed said that almost explicitly that they're going to start buying corporate bonds for individual companies. And all that means is it gets increasingly more difficult to sell risk assets, because if the guys printing the money are telling you that they're backing up equities and they're backing up the market in itself, it's going to be very difficult for everybody else not to take the same stance. So it would require a pretty exogenous event. Not saying that that can't happen, but it requires an exogenous event to take place to kind of stir up people to look for more downside. Now, that said, doesn't mean that we can't sell in the near term. Doesn't mean that we can't go a little bit lower, retest a little bit lower. But essentially, back in late March, early April, the Fed was basically building a money bridge. That's something that I went over in my last podcast and the last video that I put up. And that money bridge was designed to get us through whatever crisis exists on the COVID-19 front, on the coronavirus front. And the longer that the coronavirus issue plays out, the less effective the bridge gets. Now, in that previous episode, I did kind of illustrate what it was that needed to take place. And one of the primary things and one of the primary ways to look at the coronavirus situation is to look at it from a deaths metric and a mortality rate metric, and to look at it from a business cycle recovery metric. So basically, the longer that corona sticks around, if it's less deadly than we initially anticipated, and it remains less deadly than we initially anticipated, that is a good thing for markets, considering the amount of liquidity that's been flushed in the system. Secondly, if the money that was printed and handed out to individual citizens and consumers and to small and medium businesses suffices to get us through whatever initial instance or initial problem we had with coronavirus, then there could be an over liquidity in the marketplace that could kind of buoy things for higher resolution to the upside. Again, this doesn't mean that it can't be sloppy. It just does mean that there is a buoy in the system, and it does mean that the market's being supported by the Fed, both whether it could be artificial or not. That is something to keep in the back of your mind. Now, that being said, I know I've rambled here for a few minutes. The important thing to note is we are kind of grinding here along a previous high that we set in the marketplace. And that is a high that we set back in initially back July of 2019, then again September of 19, before we ultimately broke out, which was in October. Now, it's important to note that this high that was set in September and this resolution that began back in October began again with some Fed liquidity, and that was in the form of the repo market. And so the repo initially kind of melted the market up higher up until we saw that flush down in late February of 2020. So again, it's important to note that there is ample liquidity in the market, that there is supply in the marketplace, and the Fed's got its back. But it's also important to know that not everything will move up in a straight line, and not everything will move up simultaneously. So I'm going to show you here firsthand what I mean. And this is going to be on your screen, the NASDAQ 100. This is going to be a 10-year chart. So in the last 10 years, the NASDAQ's pretty much respected this channel that we've held. It's broken through it. It broke through it back in March of 2020 and February of 2020, and that was on the heels of the COVID-19 pandemic. But as you can see, I'm going to drag this arrow down so you can see a little more clearly that it checked back to its 200-week and held pretty firmly. And ever since we did that back in March, we've been grinding higher. Now, I'm bringing this to your attention because we've seen some pretty remarkable moves in individual stocks and in the marketplace in general. And these remarkable moves off the bottom have been primarily caused by a handful of stocks. And those are the primary suspects that we all are accustomed to. And that's Apple, Microsoft, Amazon, Google, Facebook, etc. And the importance here is that these stocks are large stocks. They're the primary stocks that will hold the marketplace higher and push the marketplace lower. But as long as we get broad participation, there could create an opportunity for these stocks individually to go down in price while other stocks rebound. And all that means necessarily is that you've got a bunch of stocks that have been treated as junk stocks for the better part of the last 5 years, and that could be your cyclical names like Alcoa, U.S. Steel, et cetera, or it could be other stocks that I'm just not listing individually. And as the picture for a global rebound gets firmer and as the picture gets better, you will or could have a situation where individual names in these highly concentrated stocks like Apple, Microsoft, Google, etc., could set themselves up for a pause and could present an opportunity for them to sell, while these beaten up names could present a bargain opportunity for those that are looking for a rebound. And I started with these two charts specifically to give you a little bit of a comparison between the two, just to give you an idea that even though the individual market is not moving in the same trajectory that the NASDAQ has been moving, with the NASDAQ being at an all-time high, it is giving an opportunity for consolidation, which could resolve to the upside and could resolve for a retest of the highs. But then secondarily, it's important to notice that the NASDAQ 100 itself is pressed up against its top channel. So I'm not saying here that the NASDAQ is going to sell off or it's going to create some sort of chaos or it's going to be a negative thing. There is a real potential here with the amount of liquidity in the system that this 10-year channel that it's been respecting just gets blown off, right? So there's a chance that we just blow right through this channel. And in a situation like that, you're going to see probably a performance chase to the upside, unlike anything we've seen in the last 10 years. So with that in mind, with that preamble and that ramble, I'm going to go over a list of stocks that I have, and I'm going to go over a couple scenarios here just to give you a little bit of idea of what it is that I'm looking at. So I'm going to start with everybody's favorite recently. I'm going to start with Tesla. So Tesla is about as technically magnificent of a stock that I've seen in the last 5-10 years. I used to trade Netflix pretty aggressively on a technical side in its early hypergrowth stage. And that really gave an opportunity that I hadn't seen until Tesla recently. And there are other stocks that did that, but I haven't seen on the options front and on the equity side a mirroring like that since Netflix. In Tesla's case, Tesla's been pretty respective of, ever since it's broken out of this multi-year, you can call it a top channel resistance, whatever you want to call it. Ever since Tesla broke out here in in December of 2019, it's been pretty parabolic and it's been up and away. So if you've read any technical analysis book, or if you follow technical analysis, or you check out any beginner's guide or anything like that, typically you'll see in these books, videos, etc., that you'll get a stock breakout, and in this case, it broke out in December of 2019. Tesla did. You'll get a ramp, and often they'll tell you that you'll get a retest of that breakout, and then a further ramp higher. So Tesla, remarkably, did just that. It broke out of this multi-year sideways action. You can call that a 400 breakout. You can call it a 380 breakout, whatever you want to call it. And it just, it created a slingshot effect. Tesla, in fact, was my number one stock going into 2020. It's proven that is, and that has been the case. And then I have this arrow here of late January 2020, where Tesla, after gapping up, it stalled, and then that was its near-term top. And the reason that I'm highlighting this arrow is because if you've watched any of my videos, I'm a momentum trader at most, or excuse me, at least. And all that means is I'm looking for stocks that are respecting their 5, 20, and 50-day averages for the most part. And this arrow highlights an extension above the 5-day that we haven't seen since January 2020. We haven't seen until this last Friday, or this last Thursday, excuse me. So currently Tesla has extended beyond its 5-day. That doesn't mean that it can't continue to go higher, because with all intents and purposes, we've seen that with a lot of stocks where they just continue to go higher and higher and higher. But all that means for me, and in my case, I unloaded everything that I had. All it means is that it sets itself up for a little bit of exhaustion. And in the case of Tesla, it's shown an ability, and a remarkable ability, to exhaust itself to the upside, and then just kind of work off that exhaustion by going sideways. So in a previous example, I'm going to give you another example here. In a previous example, Tesla, after breaking out here and causing some sort of exhaustion, it did the same thing again in February of 2020, February 19. And for the next couple of days, Tesla went sideways before it fell apart with the market. So all this candle here on July 3rd is suggesting, or July 2nd, excuse me, is suggesting, and all I'm suggesting is that there is a potential for a little bit of sideways action and for a little bit of fatigue in the stock. The important thing to note here with Tesla is that when Tesla first started its ascent, its ascent with a greater than 20% short interest. And currently, last I checked, short interest was around 10%. So a lot of this move has been just shorts getting burned and people just capitulating. But just understand that as you go farther and farther up, the stock has fewer and fewer shorts to fuel it higher. It doesn't mean that it can't fuel higher on its own and on the back of metrics and on the back of actual fundamentals, but what it does mean is the fuel that it recently saw with a 20+% short interest and with 20% of the stock being held by Elon, that number on the short side has dwindled down below 20%. Moving to the next one that I liked to flag is Akamai. Now, Akamai's business is basically the pipes of the internet. So as you need more and more bandwidth, and as more and more people need more and more internet, this is a company that should do well. I'm flagging this one because Akamai had been consolidating for about, call it 3 months. It formed a little bit of a cup and handle. It formed a little bit of a broad base that it could break out of, and it's broken out of this recent range here with the 107 top. So Akamai is a stock that I'm looking for potential continuation or potential momentum here in the short future or the near future. Also looking at Now. Now is a stock that I own personally. I've owned it for a while. This stock has been in a pretty clean channel for the better part of 4 years. It's also been in this mini channel within the channel in the last couple of months. And as you can see, it hit that channel top and kind of was met with resistance. So I'm looking for a potential continuation through this channel. If it breaks above, I'm looking for it to get to the top of this channel. And maybe if it gets to that point, you're going to see some capitulative exhaustion. Another thing you could see is a failure out of this small channel that we have and a retest of the 50-day, then 100, 200-day. With earnings season around the corner, there's a couple things, or there's a couple of levels to really watch for. One of the levels is this recent high breakout point. Another level, like I said, is the channel top, and then this little mini channel to watch, followed by the different moving averages. The next one I want to highlight is Amgen. Amgen is a stock that we crushed this last week. Part of it was a little bit of luck. Part of it was just a headline. Part of it was just, the market itself. Now, Amgen has been in a multi-year sideways. It had been in a multi-year sideways pattern before breaking out, and then recently it's been in a sideways consolidation, which you can identify as a cup and handle if you want to look at it that way. That started back on December 16th, 2019. Or you can view it as just this top that was blasted through, this 245 top that was blasted through 3 days ago. So Amgen is a stock that I'm going to look at and look for as a possible tell. And part of the reason that I'm looking at it that way is because the IBB, which Amgen is a large part of, is a ETF that had been in a basically 5-year sideways range. So I misspoke earlier, and the reason that I misspoke is because I was thinking of IBB while talking about Amgen. But the IBB itself has been in a 5-year consolidation range, whatever you want to call it, and then it just recently broke out, and it's currently residing above that breakout point. So I'm going to highlight this breakout point in blue for you so you can see it. So we had a 5-year range in the IBB, as you can see, highlighted by blue, that we just recently broke through. If the IBB does not fail, or if there is no market failure here, and my bias is there's too much liquidity in the system for us to see that kind of failure, the IBB is a solid component of the market that could and should benefit from this excess liquidity, from a potential COVID vaccination, cure, whatever, and from just 5 years of pent-up resistance and demand. So again, going back to Amgen broke out at 245. This is a stock that could really get some momentum behind it if it has any sort of consolidation. Just below this 245 level, you have the 20 and 50 day. You're having a crossover there, and then you're going to have the 100 and 200 day active support. It is, recently it has snapped well above its 5-day. I am looking for a little bit of sideways action. I'd love to see the 5-day catch up to it. I'd love to see a check back of this 245 level while the other moving averages catch up to the name. But, things can get parabolic pretty quickly in this market, and they can continue. Outside of Amgen, you can pull up the usual suspects, one of which is Gilead. Gilead has been in this triangle that's forming. It looks like it could break out at any minute. Looks like it could fail there. We'll see how it resolves. Personally, like I said, with the amount of liquidity in the system, with the Fed backing the market, I'm looking for resolutions to the upside. Gilead is one that I will target. Another one is ILMN. ILMN has been in this huge range that started in September of 2018, and we're pressing back up against these highs. And if we can get any kind of sideways action, as you can see, it got sold recently. But if you get any sideways action and you get a breakout, let me highlight this in blue as well, and you get a breakout above this 380 level, this is a stock that could really get chased, considering, like I said, you've been in a range since September, October of 2018. So you've got 2 years worth of range. You've got a lot of pent up demand. You've got a really big cup and handle, if you want to call it that. If you want to call it a cup and handle this way, you can do that as well. But this really gives a pretty large, massive measured move to the upside, and it's one that I'll watch. The next is Regeneron. Same deal here, guys. You have a range, if this can catch up. You've got a range that started, that was put in from the start of 2015. You've got 5 years worth of pent-up demand, and you're currently consolidating above this range. We can draw a top here, and if the market starts to like bios, and if bios start to take off, this is one that could really perform or really outperform moving forward. You can go through the IBB components yourself simply by just going to the IBB components and searching for the components yourself. So you could literally just pull up the components on your on Google. You can just type in IBB components and then just go through them one by one. So I'm gonna pull it up here. So yeah, you can pull it up one by one. You can pull up the IBB components, and then you can start to, so click on holdings. You can pull them up one by one. You can just start to go through them one by one. So in this case, Vertex, let's say, Vertex, another one, up and to the right, and then go back. You go with Seattle Genetics, the next one. Again, you'll see constructive chart after constructive chart after constructive chart. The one that hasn't been acting properly that I saw was BIIB. Now, obviously, with amount of liquidity in the system, there is a chance that this could flag and go higher, but that is one that I would look to avoid until it shows participation like the other ones. So far, that's been the one that has been the laggard that I don't like. The other ones I do like. Alexion is another one. Has this downtrend, broke out of the downtrend, now consolidating. The next levels I'm looking for are 120 and 125. Moving along, Sarepta is another one that I have on my list. Sarepta, again, huge range, set back a high water mark back in 2018. Now we're flagging close to these highs. If we break out of these highs, look out. Another one is BMRN that I have on my list. It really looks like it wants to challenge these highs that were set back in 2015. So you can start there. You can go through them one by one yourself. You could also check out the XBI. It's another one that you can check out. This one's already broken out of its multi-year range and is flagging for higher. Outside of that, the next sector that I would want to look at is your stocks. So in the old days, they used to say your transports were your tell on the overall economy and on the overall market. Personally, I believe today that the chips and the SOX semiconductor index is the tell on the economy and on the market. So currently you have a cup and handle, if you want to call it that. You have a prior high being challenged. You have this flag, if you want to call it a bull flag. Here you go, your pole, your flag. You got a wedge. We can draw a wedge out here. So we can draw a wedge. You got a wedge being formed. Or you have just a resistance level. It doesn't really matter how you identify it. The important thing here to note is that you've got constructive action in the semiconductor space. And if we are to blow out of that NASDAQ 100. Let me pull it up again for you. If we audible out of this channel, one of the performers that needs to take participation is going to have to be the semiconductors. So with that being said, you can pull up just different semiconductors. You can see Avago is one, for example. Broadcom. Broadcom set a high water mark back in December of 2019, challenged it in 2020. Here we are, high and tight, flagging, wedging, whatever you want to call it. And it looks like it wants to retest these highs. If we blow out of this level, if we blow out of this high that we set back in early 2020, I'm going to identify it here with this arrow. If we blow out of this high, just watch out. You're going to see some performance chase. The next one I want to pull up is KLAC, really high and tight. Again, respecting its 20-day, respecting its 5-day. Looks like it wants more highs. The next one I'm going to pull up is Qualcomm. Qualcomm looks like it wants to challenge this high water mark that it set back in late 2019. So if you pull up Qualcomm, Qualcomm is an interesting chart because this is a high water mark forever, pretty much. You can just pull back. Outside of that level, you'll have the 102 mark set from its, 1999.com range. So if Qualcomm can get above this high water mark it set late 2019, you're looking at all-time highs being challenged. And then if we can somehow manage to get through this 102 level, you're looking at a lot of potential squeeze left in that stock, considering that it would make a new high. I think it's very important to point that out because you're looking at, in situations like this, you're looking at 20 years of pent-up demand. So if I just pull up Microsoft for you, Microsoft's high water mark came in 1999, and that high water mark was about that 63 level. And as you can see, once it took off, it really started to accelerate, and it's continuing to be one of the top performers. So Qualcomm is one that I want to point out. Another reason I want to point it out is because Qualcomm is often brought in as a stock that is at the center front of the U.S.-China relations, and it's also at the center mark of the 5G upgrade cycle. So let me go back to the daily. Another one I'm going to pull up is NVIDIA. NVIDIA, there's nothing negative you can really say about NVIDIA. The one thing that I haven't liked recently is that every time it seems to make a new high, it seems to then get sold off. But if the market starts performing collectively, and if this COVID thing starts to wear out, with the Fed backstop and with the amount of liquidity in the system, and with potential, 5G, and with potential upgrade cycles on the line, a lot of these chip names should and could perform. From that point on, I'm just going to point out to you, the big ones that we watch. Amazon is, I think, the number one FANG performer. Last I checked, this was before this move. This week, it was up 50% on the year, which is vastly outperforming the market and vastly outperforming individual stocks. This is supposed to happen, or this is happening while Amazon is supposed to be in a spending cycle. So you'll want to highlight this July 24th date for Amazon, because if their earnings come out and Amazon suggests that they're continuing to be in their spending, in their heavy spending cycle, there is a potential that Amazon disappoints investors. And so you'll, with a stock like Amazon, you want to highlight critical levels in it. You want to highlight different moments and different times that the stock could be buyable. One of the levels that you'll want to highlight is this 2050, 2040, whatever you want to call it, level that it broke out of back in July of 2019, and then again in February 2020. And the reason you want to highlight that is because it's synonymous with its 200-day. If it gets close to that level, and it may not even get there, because by the time they have earnings, the 200-day could have elevated, but you'll want to highlight the 2200 level and the 2050 level in a stock like Amazon, should it continue. The next one, let's pull up Apple. And so Apple, again, same thing, broke out of the February 2020 high that it set, which was 328. And there is a potential that this stock goes back. That would coincide with its 50-day. So if there's any negative headline, if there's any sort of selling in Apple, look for that 330 level, look for that 330 mark to act as support in Apple. Microsoft, another one. Again, there's that 190 breakout in Microsoft, and it could provide some sort of support. Below there, look for 180 to find support. And then outside of that, I'm looking for the 200-day personally. Netflix is another one I'm going to pull up. Netflix has been in this channel that it's respected. It's highlighted in black. Every time it's gotten to the top, it's sold off. Recently, there's also been this, I've noticed there's been some selling against this blue line that I drew out here. I don't know if that's a different channel that I'm not seeing personally, but that is something that I have flagged, and it has worked as some sort of resistance that I've brought out. From there, let's go to Facebook. Facebook challenging back its recent highs, and as you can see, caught some selling pressure. Facebook, when I zoom out, you'll see that this 220 level should act, and it recently acted kind of like support. Outside of that, you saw that the 50-day this week, or excuse me, the 100-day this week acted as really pivotal support for Facebook. So any negative headline or any negative news, if it persists, I'm looking at the 100-day followed by the 200-day. Outside of the 200-day, there is this 200 level that Facebook broke out of recently that acted like pivotal support in the stock. And so it's important to flag that level as well. Outside of that, we have Team. So there, a lot of these cloud names have started to outperform and show strength. Team is one that I like for potential upside. Let's pull up CRM. Typically, these things tend to move with with Salesforce, and CRM is a stock that I will highlight. I don't personally trade CRM. I find that it's a little bit messy. It's one of those stocks that I guess you could own instead of trading. I'm going to pull up Google. Google has not tested its highs. It's the one FANG stock that hasn't tested its highs recently. It's also the cheapest of the FANG names. So Google recently filled this gap that is highlighted by 1480 level, you can call it. Out above there, Google should test its highs. With all of the social media spending getting reduced, Google is set to benefit. So there is a potential that this stock benefits on the back of Facebook and Twitter advertising being cut. So this is a stock that I personally own. Again, this is another stock that I don't really trade. I own it. I've owned Google since I can remember, and it's a stock that I add to on major sell-offs. So back in March, I added on my most recent position. I'm up about 33% or something like that. It's a stock that I like to own. It's a stock that I don't like to trade. Spreads are not very helpful, and the stock itself is cheap relative to other peers, and it has a really solid balance sheet. From there, I want to highlight the industrials, and I want to point out that the industrials, after breaking out, have held their 50-day, but are showing that they are having trouble with their 200-day and then their 20-day. So like I said, I like to trade based off the 5 and 20-day. It's their momentum indicators, and I like to find sectors and stocks that respect those moving averages. That said, in the XLI, I found that Boeing kind of behaves with some momentum when it can break above its 5-day, as you can see here, and then it goes into selling pressure in its 100-day, as you can see there. Once it breaks below, or once it acts as resistance, it sets itself up for a downside, And if that were to be the case, I want to highlight this 160 level in Boeing, which could act as support as its 50-day. Outside of that, I guess the transports, IYT. So transports have never broken out of this downtrend that it started back in late 2020. They've tested and rejected as recently as, what's its date? June 5th, 2020. With FedEx's recent quarter, FedEx really knocked the cover off the ball. FedEx broke out of this downtrend that it started back in April of 2019, but it ran into resistance here. I guess this is a gap fill around the 166, 165, 170 range. So FedEx is a stock that I want to watch. I want to see FedEx potentially go back and fill. Let me put an arrow here for you. I want to see it go back and fill to this 5-day moving average, and then this gap that it recently broke out of, which would also coincide with this downtrend breakout. So if I could see FedEx go back to that level, call it the 150 level, I'm going to be interested to see how it holds, because if it can hold, it could provide some upside in the space and in the stock. UPS is another one. UPS got to 120, sold off. 120 was its prior high, sold off right there. But you still have the 20-day acting as support and acting as a crossover momentum indicator. You have the 5-day, which should act as support as well. So UPS is another one. Beyond there, you've got the truckers. They're acting pretty resiliently, quite honestly. And JBHT is one that I like. If it could get above this 122 level, it's a stock that I'm going to flag for potential upside. Outside of that, you've got the XLY, which is consumer discretionary. This is a little bit different than the XRT because the XLY includes stocks like Amazon and Netflix. So the reason that this one will perform versus the XRT, which doesn't perform nearly as well, is because of the weight of Amazon and Netflix. So XLY, I'll go back here. And within these retail ETFs and within this retail sector, I'm interested in other names like Costco, which seems to be grinding here. I'm going to pull up a weekly chart because I know Costco is holding its 50-week here. So if Costco could get any kind of headline that it sets itself up for, it should snap out of this. Let me isolate this with pink, I guess. It should snap out of this pink downtrend and could set itself up for more upside. Outside of that, let's take a look at what Walmart's doing. Walmart's in this downtrend. It's holding around this 200-day. I'm going to pull up a weekly, see if, or I guess monthly. Pull up a weekly, see if it's, again, same thing. Holding its 50-week, which I guess coincides with a 200-day. So if it could break above this downtrend after holding the 50-week or 200-day, Walmart is another one that could set itself up for potential upside where it could challenge 125 and then ultimately 128 before it challenges its all-time high at 133, 134, 135. So those are some names. Outside of that, I like individual names. So I like Lulu, for example, still holding its 5 and 20-day. If it could hold there, and if it could take out this 325 level, it sets itself up for more upside. Nike is another one. Nike recently has been in a downtrend, so we can just identify that downtrend there and clean it up a little bit. And so if Nike can hold in this downtrend, if it could break out of this downtrend, I'd look for the previous high of 105 to get challenged. Outside of that, RH is another one. Restoration Hardware has been holding. It's a huge cup and handle, right? So previous high water mark was 252 in February 2020, and here we are, and it seems like we can't seem to quite get above that level. If we get a catalyst that could push it, or if you get some sort of volume that pushes it up, maybe it's an upgrade, maybe someone has a position. I know Warren Buffett has a position in the stock, maybe, or he did at least, maybe he adds to it or someone else adds to it or whatever the case may be. But if you get some sort of momentum there, this is a setup that really sets up for huge upside. And you're talking about, what is this measured move? So you had a high water mark here of 255, call it, and then down here of 75. So you're looking at about $170 to the upside if this thing can get out of hand and get parabolic. I'm not calling for $170 of upside, but I'm just saying that with that kind of pent up energy, that kind of pent up demand, that is a stock that I would flag. So I don't know the ticker. William Sonoma, WSM. William Sonoma is another one that I'd look at. Same concept here. You have this prior high level of 76 acting as support, and then now we have this level of 88 acting as resistance. So if we could go sideways here a little bit, have a couple of these moving averages catch up, the 88 breakout, I'd look to be a buyer. Ulta is another one that I find interesting because it recently broke out of this downtrend after some volume selling. It's currently holding its 5-day. If it could continue to be constructive, it could potentially challenge all the way up to its 200-day. It's not something that I would look to for easy money. I like momentum. I like things that are pointing up and to the right. So another one that recently broke out on the back of a headline was Nu Skin. So Nu Skin recently had their earnings expectations or guidance, where they revised, saying they're going to have a solid report. We'll see what happens on, August 5th, I guess. But Nu Skin is one that I want to look to. Another one is So Young. This is a Chinese counterpart that moved on the back of Nu Skin. I like stocks like So Young over stocks like Nu Skin because they are a lot smaller, so they could be pushed around a little bit. So this is an example of a downtrend breakout and of the 5-day acting as support. So stocks like this are super high momentum, and they typically respect the 5-day. I'm going to create a video about this here in the near future, but for now, just flag something like this and keep it on your radar. Outside of that, let's go to WW, Weight Watchers. A lot of pent-up energy set up here. If you get any kind of catalyst, I'd look to be a buyer. I guess we can flag the number as 27. So above 27, look to be a buyer and look for a retest of that 31 level, which would coincide with its 200-day. Outside of that, look for other small names like Apron. Again, flagging, holding above, call it 12.5. Look for upside, look for a gap fill into 15, then potentially 16.5. And if it could really get aggressive, look for a challenge of that 30 level. Personally, with the markets where they are, I like stocks like this. I like stocks that are low float. I like stocks that are not going to have a huge impact on the overall market itself. Space was one that we recently traded off of that 200-day, and it's currently respecting this downtrend wedge that is created with its 200-day. If it can break above that level, look for the 21 level to be challenged, look for the 25 level to be challenged, look for all the way up to 30 to be challenged. So these are some of the names that I'm looking at. These are some of the things that I'm looking at, some of the themes that I'm looking at. So Crowd is another one. Crowd is one that outperforms its sector. Crowd is outperforming the overall hack, which is cybersecurity. If the 46 level can break on hack, look for other peers within the space. Here, I'm gonna drag this out so you can see it. Pan W would be another one. If it could break out of this level, look for 240 to be tested, and then ultimately its highs, which is 250, to get tested as well. There are other names in the space. FireEye is one that people like trade. I hate the stock. I don't really trade it. But for the most part, for me, it's CrowdStrike, CRWD, and PanW. Outside of that, I like ZS on a watch list, Zscaler. I like to pull up, the ones that all of you trade. I haven't traded Shopify personally for the last $500 because I prefer to trade things on options, and the options here I haven't found to be profitable for me, so I avoid it. But that's another one to add to your list. SQ, another monster. Etsy, another monster. PayPal, another monster. These are, again, common threads. Wix, another monster. Common thread here is work from home, America 2.0, whatever you want to call it. These are momentum names that I watch. So if you're to think of it logically, and you'll say PayPal, Etsy, Square. So these are, if you think of it logically, you can say these are, with the exception of Etsy, these are online payment processing, right? So if I go to Visa, this is a stock that hasn't broken out. It's in this wedge, in this flag, whatever you want to call it. If I go to MasterCard, should see something similar as well. Again, if the money in the digital space, call it Square, call it PayPal, starts to dry up, my focus will shift here, and I want to see if the if the hard payment processors can break out. So American Express is one that I will highlight here because American Express is holding its 50-day. It's holding a retest of its recent breakout. And if it could get any kind of traction, let's draw a line. If it can get any kind of traction here above this wedge that it created, we can create an alert here above 97.59. Look for a retest of potentially that 109, 110 level, which is breakdown level, and 200-day. So you want to be, the word tactical gets thrown around a lot. You want to be tactical. You want to see, you want to have an idea of like, well, if the digital stuff stops working, then I can go to the physical stuff. If the physical stops working, I can go to the digital stuff. Outside of that, you want to point out that there's a defensive element in the marketplace. Gold is a super defensive, super constructive chart. I want to pull out the gold chart here. Let me isolate. So you got the 177 on the GLD, so I guess that would equate to 1770 level on gold, acting as resistance. You've got the 172 level acting as resistance, and then ultimately the 185, 186 range acting as resistance. If you can see any sort of consolidation in gold and any sort of continuation in gold and a breakout of that previous high, that 177 range, and then ultimately that 185 range, you're going to see some serious outperformance in stocks related there. So you want to pull up the GDX, you're going to see same thing, similar thing. Now that we've hit resistance there, you want to pull that up. So if the GDX can get above 37, you'll want to pull up derivatives. Nugget is another one. I've already highlighted this in our chat of different levels that I'm playing for. We played this one last week and were profitable. Didn't hit the level that we wanted, but we were still profitable nonetheless. Above 83 should give you 90, above 90, 99, above 99, 200-day, right? So you want to pull these things up and get an idea of how they trade, how they perform. You can pull up individual names like Newmont Mining, Let me pull this off as it didn't work. Yeah, so with Newmont Mining, you had a breakout. It's currently flagging, holding this 62 level seems to be resistance. Above that, you got a small gap fill at 63. So these are the ways you want to think of it. If I'm defensive, what are stocks that I'm going to go to? If I'm offensive, what are stocks that I'm going to go to? What has worked? What are the barriers? And then ultimately, if things are going to go back to let's say like this COVID thing gets more serious. Let's say that all of a sudden it mutates or something happens or we run out of tests, more people die than we expect, hospital, whatever the case may be. You'll want to pull up levels and you'll want to understand that there are different levels in the market that you want to target as downside risk. First downside risk spot in the marketplace will be that 3,000 level on the S&P. Below that 2,900, and then below that it gets really aggressive, really ugly. I don't have catalysts for downside outside of maybe election risk. Maybe there's the China headlines become more serious. Maybe there's a war that comes out of nowhere. I don't know, but you want to pull those levels out and understand where they are. For me, the downside risk is a lot greater in the NASDAQ as those positions are more concentrated. So if people start pulling out of Amazon, Google, Apple, Netflix, whatever, Netflix I guess is a smaller one, Microsoft, those are names that could really weigh on the market. One of the things to think about for those names in particular is if there's antitrust both nationally and internationally, it sets up for potential downside risk. So these are your levels. That's kind of the way that I think about things and kind of the way that I go through things. For myself, I wanted to put together this video and this podcast to give you an idea of how I think about things while I chart them, and what it is that I look at and some of the levels that I look at. Hopefully it was informative. Hopefully it helped you. If you have any questions, at me at everytimeicash or everytimeicash.com/contact. If you have any ideas or topics or comments that you want to leave them below or at me once again. And then if you haven't already, please like, comment, subscribe. The more people that subscribe to these videos, the more comments that I get, the more feedback that I get, the more informative that they are, the more time, energy, and resources I can allocate to them. And then if you have any ideas for topics that you want covered, feel free to reach out as well. And then don't forget to like, comment, subscribe. Until next time, stay profitable, stay safe, have a happy 4th, and I'll see you next time.